By the end of 2026, Canada's notorious mortgage stress test might be history, completely gone. If you're a first-time homebuyer or a seasoned real estate investor, this change would probably shake up a lot of your real estate plans for the next year. So before I dive into all of the specifics and what if scenarios, I want to quickly invite you to join my free monthly realist roundtable call on School. There's a link below, or if you comment on this post, I'll send you the link. It's a casual online hangout where we unpack topics just like this, and you can ask any burning questions that you have live with me and my co-host Nick. And if you want even more, we do also have weekly calls for members who upgrade, and I'll talk a little bit more about that later on in the video. Anyways, let's jump in here. So today we're going to be breaking down Canada's B20 mortgage stress test, where it came from, what it was meant to do, the ways that people are beating it, and why it might get scrapped or overhauled in 2026. And if you stick around, I'm also going to run a quick side-by-side example of how removing the stress test could actually boost a first-time buyer's buying power, but why investors might still be stuck in a tight spot. So let's get into it. So let's start with what is the B20 stress test and why was it introduced? In plain English, the B20 stress test is a rule that forces lenders to stress test your mortgage affordability. So even if you snag a 5% mortgage rate, the bank pretends that it's 7%, which is your mortgage rate plus 2%, or at a minimum 5.25%, whichever is higher, and they'll see if you could still make the payments and afford that mortgage at the higher rate. So if you can't, you wouldn't qualify for that loan. It's pretty simple, painful process for borrowers. The rule came from OSFI, the Office of Superintendent of Financial Institutions, which is the bank regulator in Canada, as part of Guideline B20 on mortgage underwriting. First, it was kicked around in 2012 as a response to lessons learned from the financial crisis. Back then, ultra low rates and surging home prices had Canadians piling on debt. Should sound familiar based on the position that we're in today. The government was worried that if rates jumped or incomes dropped, the wave of defaults could hit banks and the economy. And so the stress test purpose was to a safety buffer, basically making sure that you can pay your mortgage even if life gets harder and rates go up. In OSFI's own words, they were qualifying borrowers at a higher rate because it reduces the risks of mortgage delinquency and default. And I'm going to talk a little bit about why maybe it didn't necessarily do that in some cases. Originally, it applied in a limited way only to certain mortgages, but it expanded big time in 2016 to 2018. Basically, the federal government made it mandatory for all insured mortgages less than 20% down in late 2016.